Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really excited to have you here today. This is a show where we answer questions from the audience about how to improve and make a more successful retirement. And this is something we've been doing every Friday, almost every Friday, since April, and we'll continue to do these. Really excited to have you here today. You can send in your questions to asktom@talkmoneywithtom.com, or you can put them into the chat window as far as that goes. And then, of course, Eason is here today also. He'll be our moderator, ask the questions, and then I'll try to answer them. And then we'll kind of go back and forth usually just to try to fill out, the answers as much as we can. You can send in the questions at any time, including during the show or during the week. We get some that way. And then some of the questions come from strategy sessions that I have with clients that I think are worthwhile to discuss with everybody. So really enjoy this process. Of course, I believe very strongly that if you want to have a more successful retirement, the more that you know about retirement planning and tax planning and asset management, the better your chances are. And so that's what this channel is for. And so if you'd like to get more content, more education, I'm very dedicated to trying to put out, educational content on a regular basis. You can subscribe to the channel, hit that little bell button next to it, and you'll get, notified when something's put on the channel. And of course, you have a more personal or direct question, you can, just go ahead and schedule an appointment. You can go to our website, which is linked here on the channel. Also, there's a little book appointment button at the top, and you can set up a, a video or a 30-minute phone call, and we can try to talk to you and see what we might be able to help you with. So that's the process, and really looking forward to today's show. I do always like to start the show, though, with a summary of what I saw happening in the market this week. I'm actually going to talk about so far kind of a year-to-date thing as a summary, because there's some pieces here that are crossing over quite strongly between these 2 weeks. And so I kind of have two things to discuss today. One is kind of called the bad news that's happening, that's creating some of the problems in the stock market, and then some of the good news. So I'll start with some of the bad news. And of course, this week we found out that inflation for December of last year versus December of the year before, 2020, was up 7%, which is a really big number. It's the highest inflation number we've had in 40 years. So obviously the market is trying to digest that and deal with that. We also got notification today that manufacturing was down in December. Retail sales are down in December. We're hearing stories about restaurants being, kind of a lot less people in them as far as that goes. They're talking about the supply chain issues that are coming through, like the manufacturing number was down a lot on autos. And so autos are talking about not being able to get semiconductors and what have you too. Last Friday, we saw the labor job report come out for December. Not that many jobs were created compared to what was expected. Most of this can be kind of tied into this Omicron wave. Less people willing to come out to work. That creates more shortages, more people catching the virus, having to stay home for at least a little while. That creates more shortages as far as that goes. And so, when you have a lot of demand coming in for product and what have you, and then you can't really supply that at the right level, that creates a pretty high inflationary situation. So one of the biggest catalysts, though, that we've seen in the last couple of weeks to the downside is all of the things that have been coming out of the Federal Reserve. They have dramatically changed their tone since roughly Thanksgiving about, how they're going to fight inflation. So they're cutting back on their bond purchases, they're increasing interest rates, maybe at a faster pace, and maybe even shrinking their balance sheet, which wasn't talked about until the minutes were released, this last Wednesday. So all of these things are kind of tamping down on the market and really creating all of this kind of negativity. And almost all of the news that's coming out is seen as negative to the stock market. But here's what's kind of interesting in all of that. If you were to line all that up in a normal market, you'd see a pretty good downturn. And yet, if you look at the total stock market index with Vanguard, ticker symbol is VTI, I use it as a broad market indicator of what's going on with the stock market. I really like it because it has over 4,000 stocks in it, so it kind of covers everything. It's only down 2.7% year to date, which is less than I would expect with all of that bad news. If you look at the total bond market index, which is ticker symbol BND from Vanguard, again, I use that as a broad market look at what's going on with the bond market. because there's over 10,000 bonds in there. That's down 1.2%. Again, not as bad as you'd think for all of these things that are happening. So why is that? Why is the market not falling even more in face of all of this bad news? And one of the things I keep bringing up is the fact that, first of all, you have some history here. When there is a 20% year in the year prior, which is what we had, 20% or more last year on the S&P 500, if you look back throughout history all the way to World War II, every time we had that happen, the average rate of return in the next year, which is this year, was 10.4%. So that's good. Not 20 something, but still 10.4. More importantly, the market went up. The S&P 500 has a positive rate of return in 80% of the chances after that. So, these people that are running around saying the market's going to fall in 2022 because of all this bad news, they're actually on that other side, right? They're in that 20% group. If I'm going to be a betting person here, I'd rather bet on the 80% group, until proven otherwise and what have you as far as that goes. So, there's some things to look forward to this year that I think could create that positive return, or that maybe even positive 10.4% average return. Number one is the stimulus money that was pushed out last year isn't coming out this year. So that's going to continue to kind of burn off throughout the rest of this year. Because one of the things that's happening is we have this high demand. And so if we bring demand down to a more reasonable level, that could help inflation. So stimulus money coming down. I think one of the other things is that the pent-up demand, with everybody was sheltering in place and locked in their homes, and some people are still doing that, but we're seeing much more motion and things that are moving around. Maybe a little bit of a backtrack here with the Omicron, but nonetheless, I think that pent-up demand isn't going to be quite as high throughout this year and maybe even the second half of this year as far as that goes. So that brings down demand. Then you have the Federal Reserve doing all of these things. First of all, the first thing the Federal Reserve does to try to bring down demand is talk about it. And so they're talking about raising rates. They're talking about cutting back on bonds, talking about, shrinking the balance sheet. All of these things have driven up interest rates actually on a lot of different areas, including mortgages and all these different things, without them even having to do a lot of those things they're talking about. Ultimately, though, they will do some of those things. And in all cases, when you raise interest rates, it costs more to borrow. So people will do that less. When mortgage rates go up, people won't be refinancing and cashing out as much. Companies will have less ability to borrow at these higher rates, and that'll slow down demand. So when you slow down demand, that could lower inflation. But then the other side of that, which I think is really important and not being talked about enough, is I feel like supply chains will improve throughout the year. Humans are really good at supply chains. We have troubles, we figure them out, we go around them, but companies are even better at it. If I own a company and I know I have this high demand and I'm having trouble reaching it because of my supply chain issues, I'm going to work really hard to try to meet that demand because I know it's there. And so I think that's going to be one of the things that happen. And we have seen some supply chain easing that's now been pushed back a little bit because of Omicron, but hopefully Omicron comes down quickly and we can get back to the supply chain easing. But I think throughout this year, we're going to see supply chains come down. So if you bring down demand and then the supply comes up, inflation could be lower. So instead of this, 6 to 7% inflation like we're seeing now, I think we could see 2 to 4% inflation by the end of the year, which would be a much healthier environment for the stock market, especially with the Federal Reserve constantly coming out and hammering the stock market with their comments. Hopefully those can start to mitigate some, especially in the second half of this year. So the virus is a problem. We're seeing that right now with the Omicron. But let's put it into some perspective as far as that goes. So last year, the virus was a problem. We had a big spike at the beginning of the year, had the Delta variant in the summer. And then of course, Omicron started, roughly around Thanksgiving, at least the conversations about it. And so very unbelievable scenario that we were dealing with, yet the gross domestic product was up 6% last year. That's a huge number. Now, it's coming off of a weak year in 2020 on a comparison basis, but the average gross domestic product is 2%, and we grew 7.5% in the fourth quarter of last year. So even in the face of all of those things, we're seeing some growth in the overall economy as represented by the gross domestic product. And I think personally that, we're not going to see the big lockdowns and those different types of things that happen, even if the virus, continues to create new variants that create problems, for the most part, we'll continue to kind of muddle through as far as that goes. So the last piece is the most important, and that's earnings. So understand that for the fourth quarter, earnings reports that are coming out now, we're in the kind of the beginning of earnings seasons. The expectation is that we'll have a 22% growth in earnings for the fourth quarter of 2021 versus the fourth quarter of 2020. That's a big number. That's actually a really big number. But more important is that for the last 6 quarters in a row, the companies have done better than expectations. And so whenever they do better, the market jumps upward for those better. So Wall Street, the analysts that are pessimistic in comparison to what has happened in reality. Companies have been able to increase earnings at an even faster rate. It'll be harder to increase earnings at those rates because we're now going to be comparing to better quarters. It'll be harder because we have inflation and these different things that are happening. But boy, I sure have a really high level of confidence in American companies, especially these big ones, to be able to kind of manage earnings, continue to manage their top line growth, especially in the face of this pretty high demand. So earnings are a very strong correlation, in my opinion, in my experience, to stock market growth. And if we continue to have earnings growth through 2022, which we would have unless we had a recession, which I'm not expecting, I think we could still have a pretty good year. I do feel like this is going to be kind of a tale of two halves, so to speak, this year. This first half of this year going to continue to get pounded by the Federal Reserve, continue to hear about inflation, continue to deal with some of these variants and some supply chain constraints and things. But as those start to ease, I think the second half of the year could be a lot better. And we'll have the election out of the way. Historically, a midterm election does better in the second half of the year than the first half anyway. So I think this maybe even more so. So I think we're going to need kind of two ingredients this year. Number one, got to keep some positive outlook. It's going to be really easy to get sucked into the vortex of negativity because there's legitimately some good negative information coming out now that are driving the market down, rightfully so. The inflation and the supply chain issues, the variants, those types of things. But there's an awful lot of positive things happening also with the high demand and the earnings growth and all the things I just talked about. So keeping some positive outlook. And then secondly, I think unlike these previous years, I mean, we've had an awful lot of really good returns month by month, quarter by quarter, very consistent. We're not going to see that at the first half of this year, in my opinion. So we're going to need more patience in order to kind of get this better rate of return that we might get for the whole year. We're going to need some patience. There's some things that we can do to take advantage with some opportunistic rebalancing and what have you, but just having a little bit of patience throughout this, churning that we're going to go through here for a little while. Possible that the market goes down further from here before things start to get better and what have you too. And that's going to be part of kind of, having a positive outlook and keeping some patience. So that's what I see this week. I think it's still a very fascinating market time frame. It's a great time to be an investor. It's a good time to be learning about investing and learning about what's going on there. So look forward to talking to you about what's going to happen next week. Thank you very much. All right, Eason. Let's talk about some of the questions that came in and let's see if we can answer some of those.
So one of the questions that we've been seeing a lot in client meetings is I have some largeable taxable gains on some positions and they're not doing as well as the market and kind of poorly underperforming. What should I do about these positions?
Yeah, this has been a really common thing, especially in the taxable accounts that we have in 2020. The broad market indexes that I really like were kind of underperforming because such a big chunk of the economy was essentially closed down. Airline miles at one point dropped 96%. Some of these crazy things, energy and all of these areas dropped because people weren't moving around. And so all of that money started to be funneled into smaller areas. Innovative technology, genomics and clean energy were the three biggies. And we ended up with some phenomenal returns in those. But they peaked out in February of last year. And so what do you do with that? It's very interesting, right? So if it's in an IRA, we we basically got rid of most of those and went back into a more diversified portfolio in the first half of last year, most of it in March of last year. So that worked out well because they've come down some more. But in the taxable accounts, you have these big gains. And so this is a really interesting question and a situation where, people want really no taxes in a perfect world and maximum returns. But when you have this, we're in the middle of a pandemic. And when you have these kind of cyclical things that are happening, and you had to go into one area that skyrocketed, made you a gain, and is now falling out of favor, you need to sell those. You need to take the gains as far as that goes. And so we have been very aggressively this year, certainly very aggressively selling those pieces and taking some of the gains. I'd rather have the clients call me up to take the money out of their account to pay the taxes than have the gains disappear. And so I think that's strategically, it is difficult to figure out when you should take gains. That's more of an art than a science. I will always give, fairly high levels of latitude to a position, especially one that's kind of cyclical, in hopes that it continues to rebound and come back. But honestly, if it gets past half of the gain, if I have an $80,000 gain and it gets down to 40,000, I'm probably going to take that $40,000 gain. Even though it's painful to pay the taxes, it's better than having that gain turn into 10,000. You're better off paying the tax. So sometimes that's an interesting, conversation with people. It's just this concept of, net rate of return after tax. And it's not easy. Generally speaking, taxable accounts, which is what I have set up now, my portfolios are more broad-based, not so cyclical, not so, up and down. And so maybe we can hold on to those for the long term, the Vanguard Total Stock Market Index, the Vanguard S&P 500 Index, and these types of things that tend to be more bellwether, all-weather type of accounts versus these more narrow pieces that we were kind of forced into in 2020. And so it's going to be a little bit of a painful transition because of taxation, but it is something really important to kind of understand that sometimes it's worth paying the tax. If you put tax as your number one criteria on an account that is taxable, lowering tax, first of all, you have to have a very special portfolio to make that work. And it's very likely that you might make less than you would if you were able to just look at it from a net after-tax rate of return standpoint. And that's just my opinion, but that's been my outlook and what I've actually experienced here also.
For these positions, do you ever or there's like that short-term and long-term gains. So like when you do this calculation, are you thinking about like, hey, I'm a couple months away from a long-term gain. Is it worthwhile just to risk it to wait till that, that 1 year hits?
Yeah, no, that's a good question. I hate short-term gains. Having said that, I have a lot of clients that are in a 15% tax bracket on capital gains and probably 24% tax bracket on short-term gains, ordinary income. The state tax might add another 2 or 3%. So you kind of have to look at that and what's happening right now, right? So am I going to wait 2 or 3 months and lose that difference? Because honestly, what is that 10, 11% difference? So 2 or 3 months, if you've got a position that's falling pretty hard, you lose that easy. So I'll take a 2%. I'll take a short-term gain if I need to. Again, I try to, and this is not scientific, but I try to use kind of a half as the key. If I've got an $80,000 gain that's turned into $40,000 gain, whether short-term or long-term, and if I feel negatively about that position and really trending downward, I'm going to get out of it. And then also there's some future thought process. I mean, you have to think about it, like think about, what's happening. So small cap stocks are taking it in the chin, especially the small growth stocks, which is not an unusual situation in a higher inflationary environment, because when interest rates go up, the multiples, those companies are selling for a lot more times their earnings, if they have earnings. And so they tend to sell off in these environments even more. So again, it depends on the situation. There's not a scientific perfect, rule of thumb there. But boy, I sure have watched a lot of people, let gains disappear in order to avoid taxation. I think that doesn't make sense to me. I'd rather pay a short-term gain if I had to.
Yeah. And so with the changing market, what are you investing in, like with this current market?
Yeah, this current market right now, I'm really looking strongly towards having a very, very diversified portfolio for starters. And because I think one of the things that I find really fascinating is how sold people get on a certain path that might happen. We're having inflation. I got to buy gold. I got to do this and that. Okay, that seems like a good path. It seems like a good probability. But there are more variables happening this year than in any other year I can ever remember. When you have the Federal Reserve getting this aggressive with their conversations and their possible, fighting inflation, you have this inflation this high, you got a reopening, you got a pandemic, you've got the possibility of another variant slowing things down, you've got an election on top of that, you got supply chain constraints. I've never seen anything like this. You've got a whole workforce that's shifted to a certain degree. We've have some of these shortages in labor are because there have been massive retirements. People have accelerated their retirements 2, 3 years in advance. These are all variables that you're going to have a really hard time figuring out the direction. And you might think, hey, financials and these different things are the greatest thing on since sliced bread, but we have 75% of our assets in the S&P 500 and the total stock market index, just because of the fact that I don't know for sure where things are going to go this year. So that's number one. And so then the rest is decided on, okay, what do we think might do well? Um, I like semiconductors. They haven't outperformed so far this year. The index that I'm using right now is SOXX. It's iShares semiconductor ETF. I think it's down about 1% more than the Vanguard Total Stock Market Index. It's up today, up 2% today. So maybe we're catching up. Anyway, and so, because semiconductors are pretty unique, everything you read is always a shortage. And then Taiwan Semiconductor, released their earnings, and they did fantastic actually, and huge demand. And man, what a group right now! And it's sort of isolated. You can't open up a semiconductor company tomorrow, and can create competition. So they have trouble meeting the demand. I think that eventually, works its way out. But could be a good year for semiconductors. It was last year. I think that index was up something around 60% versus the market. So I like that category. I like something that has a lot of demand, irregardless. It's down a little bit more right now because some of these companies have higher multiples and there's a shift towards kind of value, but it keeps coming back, which I like, including today. The market's down today and that's up, so that's good. That's a good sign. I like Apple personally. It's one of my other targets. I think, I bet you they had a good fourth quarter. I'd like to see what's going to happen there. They're sort of an all-weather stock. They're selling at 30 times earnings, so that's pretty high. Not as high as a lot of the little stocks, but so they're taking a little bit of a hit here with this, flight to values, flight to inflationary environment. But I think you just wait for them to churn out their earnings, which have been pretty good. And they have a nearly cult-like following. People buy Apple, just because, and they come out with something new, they buy it, and they're working on these new VR goggles, right? And they've got the Apple Car out there. They're buying back $90 billion worth of their shares, this year. It's just, I think it's a great story. They have great cash. They're not really reliant upon, borrowing to run their business. So higher interest rates won't affect that as much. So, I think they've got some headwinds in front of them, but I like that company. I think that's a good place to be personally. So, the targets are pretty small and few in between right now, things that I just really kind of believe in. Mostly we're staying very diversified. And again, that's been my drumbeat for quite a while right now. I think you've got to be really careful about getting too narrow here. You might look right for a while, but then all of a sudden, inflation turns out to not be the big boogeyman people thought or what have you. There's a lot that can happen, and I would be watching that supply chain issue because I think once that resolves, we will see, inflation moderate pretty rapidly, and maybe even to the point where the Federal Reserve doesn't have to do as much aggressive work against inflation as thought. That would be great for companies as a whole. If you're on that inflationary side with all of your gold and all of these other value stocks that do well in inflationary environments. So I don't know where it's going to go, and so I'm going to buy everything and let that go. And um, VTI is down 2.7%. A lot of these targets, there's some that have done better. Mid cap value, small cap value, large cap value generally has done better than VTI. But man, there's a lot of pieces out there that have done a lot worse. That's where it'd be really hard. It's sort of a minefield, in my opinion, to get out there and try to figure out what's going to do well.
Yeah. So international stocks have been doing well for the past week. Is this on your radar and should I be looking to buy these?
Yeah, international stocks have had a good 5 day run here, actually. Really outperformed the stock market here. I watch international all the time. I have almost no exposure to international stocks, which is unusual. I usually have something, but since this pandemic started, I haven't had really much of anything. And there's a variety of reasons why it's not doing as well, but there's a lot of reasons why it should be doing better. First of all, the multiples are better there. There's because they haven't run, they're not as expensive, and I think there will be a point in time here where international, and I generally deal with the broad, like VXUS, which is the total international stock index, maybe VWO, the Vanguard Emerging Markets Index, those types of things. I like the broader stuff in that arena more than trying to get targeted like certain countries or what have you. But for me at the moment, the run is too short personally. So I'm not going to buy into those. It's been 5 days. We've had several other runs that have happened that have failed. The other thing I do worry about is although the dollar is a little bit soft right now, I'm not sure it'll stay that way for the year. And when you're buying a foreign, stock, it's in a foreign currency and it's going to come back as dollars. If the dollar goes up, the value of your investment could go down, even though the stock is doing well, just because the dollar is getting stronger. I could be wrong about the dollar. A lot of people were wrong about the dollar last year. Thought it was going to do poorly, and it did quite well. Had a good year. And right now, I think it should be doing better, and it's not. So who knows? But I'm a little bit worried about what might happen with the dollar in terms of its strength and how that might impact the returns that we're seeing on these international investments. But it's something I will be watching for real closely. I'm a more aggressive investor or somebody who moves in and out faster might have already jumped on the bandwagon, but that's not how I invest the money as far as that goes.
Yeah. So here's a planning question. How do I balance my child's education with my own retirement?
Yeah, that's a good question. That's come up before too. I really think that's a kind of a core question because both are expensive, right? In today's world, the college costs can be quite high, and the retirement takes a lot of money. And so if you spend a lot of your money on your child, will you have enough money for your retirement, right? And I think if you did the actual numbers, and I've seen several articles on this, if you did the hardcore numbers and looked at it, look at the return on investment for an expensive school versus a moderate or lower cost school. I'll bet you the return on investment isn't that great in comparison. So college isn't just college, but a lot of people that I went to San Jose State, do quite well, right? So it's more of there's a lot more to it than the college, and San Jose State was a lot cheaper than Stanford, which there's a lot of people did really well out of Stanford, but I'd love to see the correlations of how that works out versus cost. So do you spend less on your child's education to make sure that you've got a situation where you can have money for retirement. And then if you look at kind of the long-term aspects of, hey, I'm going to carve out money for this high cost college and take it away from the savings I'm doing for my retirement savings are long-term. So it could be quite expensive, where you might spend $100,000 that you could have saved. That could be millions, over your lifetime, right? In a tax deferred or tax free vehicle like a 401k or a Roth 401k or Roth IRA. So I think the numbers say that you should focus on your retirement more than the college savings. But there is another aspect to it, in my opinion, and that's more the emotional aspect. So for me, for example, I'd work till I was 100 if I had to. If my kids could get into a school that I thought might give them even a small edge, um, my kids are bright, and if they can take advantage of that and get something better out of it, I'd work until I couldn't work any longer, personally. So that's a different thing. I look at it from the standpoint of what I want to do for my children. And again, everybody looks at this differently. And there's nothing wrong with focusing on yourself before your kids. I don't know if what I'm doing is actually even worth it. To be honest, we'll find out. My kids are, 20 and 23. So there's still, a long ways to go as far as that goes, to figure out whether this, investment that I'm making pays off. But I do know it feels good to me. It feels great. I love it. I love being able to do what I'm doing and get my kids through college. I got two of them in college right now. I think I'm really proud of that, as far as that goes, and didn't have any compromises, no conversations about cost, but I worked really, really, really hard, to try to make sure that happens. So again, it's just there's an emotional aspect to that question that's different. And then there's an actual numbers, factual answer, and they can be contrary to each other. Personally, I'd follow the emotional one first. If that wasn't there, then I'd follow the factual one. So, that again, it just depends. There's not a great single answer to that. I see articles that are definitive. Definitely save for your retirement over college. Okay. But if I felt terrible doing that and felt like I was not supporting my kids at the level that I wanted to support my kids, that doesn't do me any good. Life is too short for that kind of stuff. So again, there's an emotional aspect that needs to be paid attention to, in my opinion.
Yeah, it's like the concept of airplane. You put the mask on yourself first and then your child, but
Right.
it's hard. I think there's a middle ground though. Maybe you say I'll fund your education, but maybe I'm only going to fund undergrad,
Yeah.
and you can go anywhere you want. But grad school, that's on you.
Yeah.
Or
That,
or you set the expectation. I'll pay for any kind of in-state college, or I'll
yep.
pay that money to a
Right.
private college, but you got to cover the rest. Some sort
Yep.
of middle ground.
Yeah. Well, I think there's some great studies out there that actually show that type of thing works really well, where you have some vested interest from the child, something that they have to pay for. So, for example, if I said I'm going to pay for undergrad and you're going to pay for grad school, maybe that helps in the sense that they start getting better grades in that undergrad, knowing that that would help them to get into a grad school, and maybe even get some grants or scholarships to help pay for that, right? If they've got good enough grades, and they maybe start to save some of the money that they've got from their little jobs, and they get ready for that. And so, there's I agree with that wholeheartedly. Actually, there's a responsibility and ownership aspect that you could instill, in finding some kind of a middle ground instead of just rolling out the red carpet, completely. Yeah, no, I agree with that.
So another question is, how do the new R or required minimum distribution tables affect my retirement? I know that the first of this year there's new tables.
Yeah. So what Eason's referring to there is if you have a retirement plan, a 401k or an IRA, especially traditional ones, this does not apply to Roth accounts. Roth are tax free. There is no requirement distribution. So when you turn 72, you have to start taking money out of those accounts. And so the IRS has a table. They call it a life expectancy table. And you take your age, 72, 75, whatever it is, you go to that table, you find this number. And then you take that number and you divide it into the value of your account at the end of the last year. So if you're 72 this year in 2021, you're sorry 22, you're looking at the end of 2021 value for your IRA. And so it's been a real problem actually because people are living longer and they haven't adjusted the table. And so we've got people that are taking a tremendous amount of money out of these accounts. So the IRS did make an adjustment to the table. And so that you'll be able to have to be required to take out less, not tremendous amounts less, but still less. I think Eason, you were telling me the other day it's roughly 5% less, which is good. That's a big deal. It'll add up. If you need more, you take more. That's fine. That's part of your living expense. But it's awful nice to have the ability to take less if you don't need it, because it is a taxable event. It can create all kinds of problems. It can push you into a higher tax bracket. It can make you have to pay more for Medicare if you're retired, which you probably will be by 72. And so, having that be moderated is actually a fairly big deal. I think you can do a lot other things to try to deal with RMDs, with looking at Roth conversions and different things that we've talked about many times on this show that I think are really important, but they don't apply to everybody and not everybody can do that effectively. So it is nice when they reduce the table. I think they needed to get more aggressive personally with the table to reduce it because people have so much more money in retirement plans. And I also think they needed to deal with the single person because I really don't feel like it's fair when a couple was working together, putting their money, in their own 401ks, and then one of them passes away, and all of a sudden one person has 2.5 million in IRAs. Now it's a single filer tax rates, single filer in terms of Medicare. And even though two people generated that, one person might not have generated 2.5 million in 401k, two people did it. But now one person is paying the tax as if they generated it. They did not deal with that problem. I think that's an issue. And so, that's just something I don't think they completely understand what's happening there. And I got some clients stuck in that situation where they're having to pay, a lot of money out for taxes, very high rates, plus, higher Medicare costs and have no way around it and no way to get out of that. So anyway, I still think it's a good thing. It's better. Even those clients will pay less, but it would have been nice to have some type of a carve out so that there was some way to keep kind of those accounts separated from the calculation for tax purposes in Medicare. It's not happening. So it's like a penalty for having your spouse pass away, which is not good.
Yeah, and I've seen some different ways to combat that is they have like a life insurance policy solely for the purpose of if one of them passes, that the other one can just convert the money to become a Roth
Yeah.
to then control like the RMDs.
Yeah. Uh, That's a that's worth repeating because what happens there is, so in that situation where there was a couple building up these two 401ks, you have a life insurance policy sitting there for the sole purpose of dealing with that problem. So when one of you passes away, the other one has this doubling in the single tax rates and all those, but you have a policy, 500,000, $1 million policy that kicks in when that person passes away, then you can convert that thing over to a Roth IRA, pay the taxes with the tax-free money you get from the insurance policy, and be able to then not have the problem I just described. So, that costs something for the policy, right? But I bet you well, I don't know about this for sure, but it's possible that there's some offsetting, gains by not having to pay the higher taxes and the higher Medicare. I think that's a strategy that nobody talks about, and it's really worth looking at. And there's a lot of uses for life insurance that people don't really get.
Yeah, so here we have another market question. Do you think we'll see any major shifts in the market as Omicron like hits peak hospitalization? I know hospitalization and deaths are starting to pick up right now.
Yeah. Yeah, I think we'll continue to see some impact from Omicron. We've seen it, retail sales, manufacturing, supply chain issues. some of the numbers that have been coming through just recently from December. We're hearing stories about restaurants and travel and the poor restaurants, I swear, they're ramping up for this huge demand and people are coming in, standing in lines, and then they finally get enough people to finally work there, and then people stop coming for a while. It's just really crazy. So I do think, that'll continue to be an issue. And what it does is it stretches out the curve. So the cases will go up, it looks like, with Omicron very, very rapidly. But then if you look at South Africa, come down very, very quickly. But then the hospitalizations kind of lag that and deaths lag that, right? So I just think it'll drag it out longer. Having said that, it might be less impact in terms of time than Delta because of the fact that it is such a fast up and fast down potential virus. So yeah, I think there'll still be some, and that's why I'm saying this is kind of a tale of 2 years in the sense because you're looking at a slowdown in some areas and the Federal Reserve talking about slowing things down, right? Those don't go together. That's why this market is having such a hard time right now. So it'd be nice to get this behind us, but I do think that it's probably not behind us for a little while. I did read a couple articles saying that the peak in cases could be really next week, the 19th. We'll see what actually happens, but so we'll see. And of course, hospitalizations are less, but there's just so many people catching it that hospitalization number growth is still pretty high. So it's going to be just part of this ride. I hope it's the last one, but I'm no longer, sure of that. That's for sure. So we'll see how this plays out. Yeah, but I do think it'll have some impact. I think it's why you want to stay broad-based. With the majority of your investments, just stay broad-based because you can't tell what's going to happen in this environment. There's too many things going on at once that could change things.
Yeah, and for Omicron, I think a word of advice that I've been hearing is if you can get like N95 masks or KN95 masks or
Mhm.
just better filtration masks,
Yep. Yep.
that's the way to stay safe.
Yeah. Yeah, I saw a great study showing, if two people are near each other, they have 15 minutes they could catch the virus. If they both have N95 or some mask like that, KN95 or FK94 masks, it's more like 2.5 hours that they can stand next to each other, before they would catch it on average. So yeah, I think, that's the big piece with this particular virus. It's very contagious, so better masking is definitely something to take a look at. But in terms of the stock market and where that impact's going to be, not everybody uh, even wears a mask. It depends on where you are in the country. So, everybody's got their own thing going on as far as that goes. So we'll see. Hopefully the impact is shortish, right? That'd be nice.
So I guess one final question. I guess a phrase that's been going around in my peer group is VTI and Chill or VOO and Chill as an investing strategy for your equities. What's your thoughts on that?
Yeah, that's been out there for quite a while. We didn't have the chill word, but there's a group called Boggleheads that always advocated, basically there's really only three or four investments you need at Vanguard VTI, which is total stock market index, BND, which is total bond market index, both for the US, VX US, which is the total international stock market index, and then as of 2013, BNDX, which is the total international bond index. So if you take those four, and you could, make a portfolio of, very, adequately balanced, and essentially don't have to do anything. Certainly don't have to pay an advisor, and Vanguard's internal costs are very, very low. And I actually advocate that. I think that's a great idea up to a certain dollar amount. Because personally, when I get over $500,000, I don't want to have everything in Vanguard. I like Vanguard. I think they're great. But, I don't want to have anything, all of my stuff in any one company, period. And just because, like, for example, with exchange traded funds, they're exchange on the secondary market, and never know what's going to happen there as far as that goes. So I do think you need some more diversified pieces, but up to a certain dollar amount, there's nothing wrong with that. That's an easy way of just kind of building up some money, and we actually do some of that with smaller accounts as far as that goes, because sometimes you got $10,000, there's not enough money to even buy the right number of shares of some of these overall portfolios. So we'll make them a little bit simpler. And so, no, I think that's a great concept. I think it's something everybody should look at. I do think, unless you're really into it and want to go buy and sell stocks and options and all these different types of things, which I have no problem with either. If you're just looking to kind of set it and forget it, that's not a bad way to go. You don't often have access to those the way we need to inside of a 401k. There's some that are sort of like that inside the 401k. And a lot of money that I look at is in 401k. So that's, kind of an issue, but, yeah, there's nothing wrong with that. It's not a bad concept altogether. That's for sure.
Yeah, and one thing to highlight is I think this is great for when you're accumulating money,
Mhm.
but I think the trouble is when there's a down market with these stocks, you're taking that entire brunt. There's less control,
Yeah.
and so you have to be careful.
Yeah, exactly. Yeah. It's there's pros and cons to every strategy out there. And so that, overall, I would say I'm a pro of that strategy, but there are some issues with it, and I don't want to put $2 million in those four pieces or those two pieces you mentioned, VTI and VOO. That seems like too much for me. Honestly, I don't want that kind of risk. The time it takes to accumulate that kind of money, you definitely want to be careful and not have it disappear because of some silly thing, like just putting too much in any one place. So, okay, good. Well, that's our show. I really appreciate everybody coming along today with us. I hope that you got something out of today's show. Feel free to send in questions this next week at this Ask Tom address. And of course, if you want to set an appointment, would like to talk about how to make your retirement more successful, then of course you can set an appointment. You can go to our website and hit the book appointment button. And of course, you can always subscribe if you want to continue to get content off of this channel. So thank you very much for coming today. I really look forward to seeing you guys next week. Thank you.